Day and welcome. We're going to jump straight into a question that's been kicking up a whole lot of dust online, especially in the crypto world. We're talking about Europe's central bank and, you guessed it, one of the biggest names in digital assets.
So, this is the big one, isn't it? You've probably seen the headlines, the speculation, all the chatter doing the rounds. Well, today, we're going to cut right through all that noise. We're going to give you the clear, no-nonsense, jargon-free answer based on what the European Central Bank has actually been up to. You know, what's really interesting is that this whole complicated story actually boils down to one super simple analogy. If you can get your head around this, everything else just sort of clicks into place. I want you to think about the difference between a high-performance car engine and the specific type of fuel it's designed to run on. Okay, so let's get stuck into it. To really get to the bottom of this, we need to pop the hood and have a proper look at the actual technology that the European Central Bank, or the ECB, was tinkering with. First up, we got to talk about something called DLT. Now, don't you worry, it's way simpler than it sounds. Just picture it like a super secure digital notebook that everyone involved in a deal gets a copy of. It lets you sling money and assets around almost instantly. And because everyone's got that copy, it's incredibly tough to mess with. So the ECB used this DLT tech to run a test on something called delivery versus payment. Bit of a mouthful, I know, but it's basically a fancy way of saying they wanted to swap a financial bond for cash at the exact same millisecond. The goal? Absolutely zero risk that one person pays but the other doesn't deliver. I mean, for big money finance, that's a huge deal. And here it is. This is where all the confusion kicks off. The private system they actually used for this test? Well, it was built using the publicly available open source code from the XRP Ledger. So, to put it plainly, yeah, the DNA of the tech they tested is directly linked to the technology behind XRP. Right, and that brings us to the absolute guts of this whole story. We have to understand the massive, massive difference between the technology they were interested in, that's our engine, and the crypto asset itself, that's the fuel. So on one side, you've got the engine, right? The fast, efficient, open source code of the XRP Ledger. The ECB had a look at this and thought, wow, that's a powerful bit of kit. Let's see what she can do. But then, on the other side, you've got the fuel, the actual XRP crypto asset. And to a central bank, that's a whole different story. It's volatile, it's private, and crucially, they don't control it. And that, my friends, is a massive red flag for them. So because of that distinction, the ECB made a very, very deliberate choice. They decided to build what you could call a massive digital firewall, just to keep those two things, the engine and the fuel, completely separate. And look, they could not have been any clearer about this. In their official policy documents, the ECB states, in no uncertain terms, that their future digital euro is not a crypto asset. Not like Bitcoin, not like XRP. It's going to be in a completely different category of money, one that's backed and controlled by the central bank itself. So what did they do in their big test? Well, they basically did a fuel swap. They took that high-performance engine they liked, but when it came time to power it, they flat out rejected using XRP. Instead, they built their own custom-made regulated energy source, a sort of mock-up of their own central bank money to run the whole system. This strategy even has a name. It's called selective adoption, and it's all about making sure they're the only ones in the driver's seat. Now, you might be asking, why does this matter so much? Well, it's pretty simple, really. It's all about ensuring the stability and integrity of Europe's entire financial system. You see, a central bank's #1 job is to control the money supply, and there is no way they're ever going to hand those controls over to a private, volatile asset that they have zero power over. So, if the ECB isn't using the XRP asset for its own big projects, does that mean it's game over for it in Europe? Well, hang on a sec. Not quite. The story actually gets a little more interesting from here. So while the central bank is off building its own walled garden, the European Union has been busy building a sort of supervised playground for everyone else. There's a new landmark set of regulations. It's called MiCA, and it's basically setting up a clear rule book for how private companies and banks can use crypto assets like XRP. And inside this new regulated playground, a lot of experts are suggesting that XRP could still play a really useful role. Think of it as a tool that complements the official stuff. It could act as a bridge asset to move money between countries super quick, or maybe provide liquidity for payments when the main systems are closed on weekends, or even help swap different kinds of assets more efficiently. And here's a key date you might want to circle on your calendar. By January 1st, 2025, Europe is expected to have some of the toughest, most robust rules in the world for how its traditional banks can hold and deal with crypto assets. This is a massive, massive step in bringing the crypto world into the financial mainstream, just all under very strict supervision. And so all of this leaves us with a final, absolutely massive question for the future. What happens when the world's most powerful financial institutions take the brilliant innovation from the crypto space, the engine, but they decide to leave the original asset, the fuel, behind? It's a debate that is going to shape the entire future of finance for years and years to come.